Good morning. I'm Jim McCann of Worth Media, and today we're gathered for the Atlas Merchant Capital quarterly economic update call. It's uh, it's an interesting time, and I'm here with two wonderful people who have helped us for the last several years now to figure out what's going on in the economy and help us plan, anticipate what changes might be coming our way, and how we can best be prepared to capitalize on the economy and the circumstances around us, or at least protect our families and our businesses as best we can. Joining me today is the co-founder, and CEO of Atlas Merchant Capital, Bob Diamond, and with him, as always, or almost always, is Professor Larry Kantor, who's the partner and chief economist at Atlas Merchant Capital. Fellas, a lot's going on in the economy, a lot's going on every day. My head is spinning, but Larry, I'll ask you to give us a brief overview of what you see going on in the economy and the landscape around us. The economy, of course, is tied to geography, it's tied to politics, it's tied to all the goings on in the world, not the least of which is just in the last quarter since we last convened, Larry. Look what's happened in the Middle East. We've experienced the 12-day war. Uh, Musk and Doge were very active. Gaza is still there. The U.S. has bombed Iran's nuclear facilities. We're in conversations with them on how to resolve our differences. The war in Ukraine rages on. The quick special military operation that was going to be over in days is now in its third year. New York City has nominated for the Democratic line to be mayor a man named Mamdani, who's a Democrat socialist. Polls were wrong again, gentlemen, this time by more than 20 points. Jobs, Larry, seem pretty steady. They're not as strong as you'd like, but they're steady. We had a great first quarter in terms of S&P 500 reports. Tariffs, they're in, they're out, they're up, they're down. The southern border is effectively closed. All immigration, legal and illegal, has come to a screeching halt, it seems. DEI is now verboten. Musk is gone at the end of the quarter, and we have a big, beautiful bill and a lot to unpack there. Larry, how do you begin to make sense of this all?
Yeah, it has. I've never actually I've been doing this a long time, and I always used to say presidents get too much credit and blame for the economy, and even in terms of policy, the Fed usually has a bigger impact. But this time around, it's it's head spinning. So let me try to make sense. But I will say this, Jim, it served me well when I'm doing this kind of thing to just stay away from politics. And, right,
Good luck.
when you're at the Fed, right, usually people will draw political implications no matter what you say. But as far as the U.S. economy is concerned, actually, we're pretty much in the same situation we were when we gave our last macro update, a few months ago. Higher tariffs, reduced immigration. There's still threats to the economy. These policies increase prices, they reduce output, but we still don't know, how big these changes are going to be and how long they'll be in place. What we do know is the budget for the fiscal year that begins in October, which you mentioned. There's lots of details. The bottom line is that it came out pretty much as expected. The bottom line is it's going to increase deficits and debt anywhere between $3 trillion and $5.5 trillion over the next decade, depending on things like how fast growth is, how high interest rates go. Uh, but interestingly, it'll provide really only modest stimulus to the economy. And that's because most of the tax cuts are merely extensions of the 2017 personal income tax cuts that were due to expire at the end of the year. Uh, the budget deficit's been running around 6% of GDP in recent years. That's the highest non-recession deficits we've had since World War II. The budget, when you do the calculations, will take that up to about 7%. If you look at publicly held government debt, It was around 5 trillion before the financial crisis. It's now almost 30 trillion. So it's 6 times what it was before. The new budget should boost the economy modestly next year, maybe a half a point of GDP or so. And that's because the tax cuts are front loaded while the spending cuts are backloaded. Cuts to Medicare, everybody's talking about, don't start till something like 2028, after the midterm. So, um, as far as where the economy stands right now, what I'd say it's holding up but slowing. So real GDP growth averaged around 3% in 2023-24. The first half of this year is not even going to come to 2%. We did have what looked like a very strong job report for June that was released on Friday. We had headline job growth of 147,000. The consensus figures were around 100. But when you look under the hood, it's not as strong as it looks. Half of that job growth was state and local government. If you look at private sector job growth, it was around 74,000. It's slowing. The other thing that I look at is you can calculate sort of income from job growth from the report, and that was flat last month after being really strong before, and mostly because the average work week fell. So there's less hours worked in the economy. So with the economy already slowing, with tariff and immigration policies likely to depress economic activity in the second half of the year, it's reasonable to be concerned about, are we going into recession?
Sure.
We're already slowing. Uh, but our best guess at this point is that the economy is going to bend and not break. And that a lot of that's because we entered the year with a lot of resilience. Um, we had, as I said before, job growth powering personal income, which supports consumption. If you look at corporate profit margins, they're still high. And spending on AI is boosting investment spending, even in the face of the uncertainty created by a constantly changing tariff regime. Meanwhile, the debt burden on households and businesses, at this point, it's not really ringing alarm bells. A lot of people locked in very low long term interest rates on the debt side. And if you look at risk taking, speculation, it doesn't seem to be excessive enough to create a systemic blow up, although there are some areas you could identify that may be overextended. Now, as far as the Fed, it's worth mentioning what we think about the Fed. The trend toward higher prices and reduced output puts the Fed in a bind. I mean, most economic shocks are on the demand side, and that makes monetary policy decisions a lot easier. So when demand goes up, you have higher prices, stronger output, the Fed usually tightens. When aggregate demand falls, usually have lower prices, reduced output, and the Fed cuts rates. Tariffs are a negative supply shock, so they tend to raise because they increase business costs. So they raise prices, reduce output, and core inflation has been running around 3%, which is about a percentage point higher than the Fed's target. And that's before the effect of the tariffs really show up in the data. Meanwhile, reduced immigration amounts to a negative supply shock in the labor market, implying reduced job growth and higher wages. Some of that will likely be passed on to higher prices. And like everybody else, the Fed's not really confident about the size of these shifts that push policy in opposite directions. So as a result, monetary policy is likely to remain on hold as Fed officials, observe how the changes are going to affect inflation and economic activity. That said, I wouldn't rule out a quarter point cut or maybe even two before the end of the year, because if you look at the current policy rate, it's 4.25% to 4.5%, and that's modestly restrictive on the economy at a time when things are slowing. Now, I think one question we have to address is if the economy's already slowed and immigration and tariffs are going to slow it further, how come the stock market's doing so well? I mean, you look at the S&P, it's up about 6% year to date. It's up about 12% from a year ago, and it's up 25% since the April lows. So nobody knows for sure what this is, but I would list several explanations for this. The first is that the economy, as you said, Jim, appears to be holding up despite the negative effects of tariffs and immigration. But now the reason is they haven't shown up yet. I mean, after all, think about it. The Liberation Day tariffs, which really shook everybody up, were announced just this past April, and they were subsequently paused for 90 days. The drop dead date was supposed to be today, actually, but it was just extended to August 1st. You look at the other thing that's really important is that the prospect of tariffs induced a huge front loading of imports. So imports of goods in the US were up 50% at an annual rate in the first quarter. I've never seen anything like
When
that.
does that correct?
Yeah, so well, that's the thing. What does that do? All these pulling of inventories of imports, it creates very high inventories of imported goods, and that keeps prices moderate. In fact, there's been discounts in a lot of areas. As these inventories wind down, prices will start to go up. It also, just remember that over half of US imports of goods are inputs into domestic production. So manufacturing output and jobs are holding up because of all the imports that, to front load to avoid tariffs. Meanwhile, looking at immigration, if you look under the hood at the numbers, job growth from immigrants is now close to zero, as you mentioned, Jim. And this is at a time when the non-immigrant labor force is actually declining. It's worth noting, immigration accounted for almost all of U.S. labor force growth in the past 5 years, and it played a key role in boosting U.S. jobs and economic activity. A stagnant labor force, which all this implies, is going to create significant headwinds for potential GDP growth going forward. So one reason is hasn't shown up in the data. Second reason is it seems like, nobody knows for sure, that market participants are inclined to believe that the president's going to back off on tariffs over time. I mean, it's worth remembering reciprocal tariffs were paused after the stock market tanked after Liberation Day. You look at China, the tariffs were jacked up to 145%. And then after the stock market collapsed, they're back down to 30%. But there's one other reason that I think is probably the most important, and that is business investment being boosted by artificial intelligence, spending on that, which I mentioned before. AI is an innovation, I believe, that it will be productivity enhancing and it'll be a big deal. It reminds me a lot of the internet boom in the late 90s and early 2000s, which, turned out to be a game changer. I mean, it changed everything, as you know. But it didn't prevent a stock market bubble that eventually burst. There were obviously lots of winners and losers. So I think those are the reasons why the stock market's holding up. I think then you've got to look at what's happening with interest rates, not just with the Fed, but bond yields. I mean, you look at them, they're a lot higher than they were before COVID. So the benchmark for bond yields is the 10-year US Treasury. That's been trending 4 to 5%. If you look at a decade before COVID, it was 1.5 to 3%, and that was unusually low.
Larry, we've seen at the same time with the bond yields holding up, though, we've seen U.S. currency trade down this year by almost 10%.
Right. Now, I'm glad you brought that up, Jim, because I wasn't even going to talk about the dollar. Everybody's waving their arms about a weaker dollar, and it's come down, by some measures 10%, some other measures.
There's an economic side and there's a political side. How do we fare in all of that?
Well, what I think the concerns are that this has something to do with capital flight. One of the people don't talk about the capital account. Everybody talks about the trade surplus, and obviously we have big deficits in that. Although in services we actually have a surplus, in goods we have a big deficit, but we have a massive capital account surplus. I've talked about this before. Foreigners buy a lot more of our assets than we borrow.
Bob brings it up on every call.
And when you see, we did see for a while higher bond yields, and a weaker dollar. That sort of makes you worried about capital flight. But I want to say this: if you look at a chart of the dollar before it started declining, it was at very high levels. The decline we've seen brings it more back down to where it was a year ago. So if you do it longer to try to, it's not alarming to me at this point. But this passage of the so-called big beautiful budget bill has, I think, prompted fears about debt sustainability, and you're hearing this across the political spectrum. Both Republicans and Democrats. And there's no doubt that we already have U.S. debt and deficits that have already ballooned to levels that are concerning, as I mentioned before. So just to give you some numbers on this, and then we'll talk. We'll just open it up for questions. And Bob, I'm sure, wants to weigh in on all this. The U.S. spent $1.1 trillion just on debt interest payments in last fiscal year. So this fiscal year 2024. That's double what we spent on that as recently as 5 years ago. It now accounts for 16% of federal spending. That's the second biggest expenditure after Social Security. We actually spend more now, the government does, on payments on our debt than we pay on for defense or Medicare. The debt to GDP ratio, you'll see higher levels than this, but it's gone from 35% to 97% early this year. And I'm just taking out the 20% of the debt that the government owes itself, federal government agencies, by treasuries. The budget that was just signed to law will take that ratio from 97%, this debt to GDP, to 125% by 2034. Now, nobody knows for sure what the maximum sustainable level is, but what we do know is that the reserve currency status, which reflects the dominant role we have in international finance, provides the U.S. with a lot more leeway than what's afforded to other countries. We have the biggest, the safest, the most liquid asset of financial markets in the world, and the U.S. remains an attractive destination for investment capital. It's widely agreed that anything like 200% would be a disaster. And we're far from that. But if you look at this recent trend, it's alarming, going from 35% to 97%, and then we sign a budget, it's going to take it to 125. And so, the Penn Wharton model investigates debt sustainability, and they released their last results in 2023, which said that under current law, we've got about 20 years for this thing to really get bad if we left it as it is. Now, the budget bill, as I said, shortens that
time frame.
Yeah. So at some point, what I would conclude is this: debt and deficits are sustainable for now. But this means that a future president is going to have to bite the bullet.
And the bullet's going to be much bigger, isn't it?
It is. And the last time we saw that was President H.W. Bush and Clinton are the last ones. So this isn't new, where we keep increasing it. Now, obviously, the financial crisis and COVID caused a huge increase in government spending. But somebody's going to have to do it at some point. But in my view, it's okay. This isn't something that's going to happen this year or next.
So Bob, I'll ask you to I'll ask you to wade in, Bob, and tell us as we look at a first quarter that had good economic news in it, quite good across the public company sector. You've had some successes with some of the investments at Atlas Merchant Capital. That is a result of the IPO market loosening up a bit. The Mag 7 seem to be roaring forward. Tell us about Circle, a stable coin, something we've been talking a lot about in the last 10 years. We have a terrific success story on your hands there with your investment in Circle. Of course, in the last 10 years, we've had 20 Circle stablecoin providers go upside down. Why is Circle different, and why is the IPO market opening up?
Listen, we started working with Circle in 2021. And as you know, Jim, because you were part of the team at the time and part of the investment group, is we looked to de-SPAC Circle at a valuation of $4.5 billion relative to the roughly $7 billion IPO price. As we've seen since that time, it's up 10, 11 times that $7 billion IPO price. So listen, this has been, or excuse me, 10, 11 times the 4.5, the earlier price. But at any rate, at over 20 billion in market cap, it's been very successful. And the question when you step back is why? There is clearly a need for a digital version of the dollar. It is equally clear that the Fed it's not their responsibility or their skill set to develop that. It's really the private sector, much as the private sector developed the Fed wire. And then the Federal Reserve Bank aggressively monitored and regulated the Fed wire. That's the same thing here. And to give credit to Jeremy Allaire, the visionary and the CEO and the founder, from the very beginning, Jeremy felt that we needed a very, very highly regulated, very, very straight down the fairway stablecoin with a dollar backing every digital version of the dollar. There's no impact on monetary policy. It's just giving an opportunity for institutions to be able to transact currencies 24 hours a day, 7 days a week, over the blockchain without the need to be paying a banker to stand in the middle. And I think this has been highly successful. It's very early days, Jim, in the usage of this from a cohort different than just crypto traders. And it's moving into corporate treasurers, corporate CFOs, institutional transactions. And I think the best days of stablecoins are ahead. Europe, the European Central Bank is working with Circle as well, as are a number of Asian and Middle Eastern countries. So we are very excited by this. I will have to take an opportunity to say that it would have been terrific if the prior administration, where the SEC under Gary Gensler was unwilling to be open about the opportunity for Circle and stablecoins at that time, and kind of slow walked the approval of that SPAC, was unfortunate, really, for the markets. We could have been a couple of years ahead in terms of these developments. But be that as it may, we are big, medium to long-term believers in Circle, in stablecoins, in a digital version of the US dollar. And Jimmy, also the power of the blockchain and the technology of the blockchain, which I believe will be the underpinnings of all financial services over the next decade.
I'm still struggling to see the use case, though. In theory, as you talked about it, and I've listened to you, the research you've done on this, the investigations you've done, in theory, that makes all the sense in the world that there's a underlying blockchain way of making payments and transacting makes sense. But heretofore, the primary use for blockchain is not for good purposes. It's nefarious. And it's feeding the scourge of ransomware around the world, which is cancer on business everywhere. So I can see in the long run the use case, but in the near term, like so many times, new technologies are used for nefarious purposes until there's enough of a normal demand. How long do you think that takes?
Well, I think that's why it was a shame that Gary Gensler and the SEC kind of closed their eyes to the developments here. And I've always said during the financial crisis that strong banks want strong regulation. Strong crypto wants strong regulation. Jeremy Allaire has been at the forefront, Circle has been at the forefront of please regulators, don't allow bad actors in here.
Yep.
And that ignorance of paying attention to what their role was at the SEC earlier didn't do any good. By not regulating something, it creates the kind of environment you're talking about. But I will tell you today, whether it's JP Morgan, Bank of America, Citigroup, or Wells Fargo, there's significant investment in blockchain as an underlying technology for traditional banks as well as for the digital version of the dollar. So a highly regulated environment monitored by the Federal Reserve Bank. If one of our investors in Asia wanted to wire $100 million to Atlas Merchant Capital in the US because of an investment opportunity, the traditional way is to call the bank, go through KYC, take through 2 or 3 days, and maybe next Thursday you'll have that wire sent during traditional working hours and a fee of 2 to 3 points. With USDC, it's instantaneous, 24/7, almost a de minimis fee charged on that, and all highly secure without a bank standing in the middle. That's a big transformation. And we are seeing corporate treasurers hold digital currencies on the balance sheet. So USDC is being used for that reason. It's the very early days. I will tell you, Jimmy, the very early days.
Bob, you and Larry and I had a chat recently, and I disagree with Larry in terms of the impact of AI. We all agree it's huge.
When's the last time I worked for you?
Never. But I'm, as a business operator, I'm concerned about the impact of AI in the near term. When I say near term, in this year and the next 2 or 3 or 4, let's call it a 5-year period, I think it's going to be tremendously disruptive to people. Our commitment at the companies I'm involved with, the flowers companies, for example, is that we're doing everything we can to invest in our people to bring them up to speed on their AI skills. And we feel our commitment is we can't tell you you're not going to be impacted. We are. Each of us will be. But we can tell you we'll do everything we can to help you to develop your skills so that you're marketable, you're comfortable, and you have the superpower, as my friend Shelley Palmer would say. People who have the tools and the knowledge and know how to use AI, they feel like they have a superpower, that they're employable, that they can go out on their own, they can teach other people. They have a skill set that's going to be in demand, even if they get disrupted. So we're investing in our people's skills, but our headcount is surely going to come down. And all of the Fortune 500 are talking about their workforce is going to be shrinking. Now, the only difference, Larry, you just talked about, the Mag 7 can't spend enough on hiring the right AI talent or build enough data centers or get energy sources. This just screams disruption for me. Mag 7 on a fly, employment for people with AI skills over the top, spending on capital infrastructure to support AI, unfathomable. Yet, us chickens are going to get crushed here in the soup. Larry, Bob?
So let me respond to that. First of all, I don't disagree with anything you just said, Jim, but I'd remind you that one of the strengths of the United States is to employ new technology early and aggressively, despite the social disruptions. Think about the Industrial Revolution. Talk about a social disruption. It used to be, at the time of the American Revolution, well over 90% of the population were farmers. Everybody lived on the farm, your kids, your grandkids. It was a social. And then when everybody started moving to the cities, everybody said, machines are going to start producing things. What are people going to do? It ended up creating tons of other jobs, car salesmen and everything else. When the internet came along, was it a disruption? Yeah, a huge social disruption. People were very upset. Everything had to change. When the internet came along, we used to, Bob, we were on trading floors. Everybody had an assistant. After the internet, only the top execs had a personal assistant because we had email, we had the internet. But other jobs were created. When Amazon came along, everybody said that's the death of retail. It has closed. Malls have been affected. The net effect on employment has been up. You can't go anywhere without seeing a delivery truck of some kind somewhere.
But that's disruption.
It's disruption, right? And it is social. And
Positive aspect, Jimmy, which Larry
so
has
to
taught me
me,
the
I
positive.
am concerned about AI too, more in the sense of, that this idea that if it develops enough, we won't need human beings at all. But don't forget, all this AI is creating tons of jobs in computer coding. Everything has to be coded so you can use AI. So there'll be other jobs that are created that we can't even imagine. Anyway, that's my take. But I do think Bob is right. It has, with crypto, with all AI, there has to be regulation to prevent nefarious, unseen consequences. So I agree. I think it is scary. It definitely is disruptive, and there's going to be lost jobs in some areas and gain new jobs in others. But anyway.
And we
So
saw
that's
globalization and its impact, and everyone says
yeah,
it's amazing. China lifted 400 million people out of poverty into some sort of middle class.
right.
But I think the people who paid for that live in the Midwest of this country. They live in Maine.
Absolutely.
Yeah, they created a whole lot of jobs there because of public policy, which enabled that, which hollowed out the industrial belt of our country.
Except for this, hundreds of millions. That's very visible, painful cost. Hundreds of millions of Americans can buy stuff for way less money than they otherwise could. And that allows them to spend more on going out to restaurants, entertainment venues, travel, which has boosted those industries. And every empirical study shows the net impact was increased jobs and increased activity.
At
Even though
the macro level. Oh, I'm
at
talking
the
about the
macro level,
consequences on a micro level.
And Jimmy,
Bob, how often do your kids and grandkids go out to dinner versus you as a kid?
they hang out with me, but that's all. Two things I want to bring up, which I think
right.
Larry has taught me from the beginning of our relationship that one of the core tenets every morning is follow the Fed, follow the Fed, follow the Fed. And I think as we follow the Fed, two things I want to point out. Larry has educated me that if this administration is correct that they're going to balance trade from a trade deficit to a trade surplus, then you are going to see, everything else being equal, the dollar decline. Because all that money, the capital account, which is if we have a trade deficit, then we have extra dollars overseas being invested in our bonds and our equities. If we balance the trade, they're going to have to sell the equities and sell the bonds. It's very simple math. The dollar was overvalued, and as we balance the trade deficit, it's going to go down. It's natural. It was easy to see that with this administration and their initiatives, you're going to see a decline from the peaks in the dollar.
So
before
you move off of that, Bob, let me.
The Fed, the second thing, Jimmy, and I think this is important, is the Fed is very, very focused on being cautious and being thoughtful. One of the other things about AI, I think you hit the key tenet. Are we training our people? The other tenet is it will dampen inflation. And I think all of the people thinking inflation is going to rear its ugly head, this is a very, very powerful dampener on inflation around the world. And I think there's some positive things there. So I think we need to continue to follow the Fed. The one thing I would add to that is also follow the policy of this administration. Deregulation, less capital required on bank balance sheets, so more lending. More capital coming in from the private sector to regional banks and community banks and to allow consolidation. So the policy is very, very clear about being more receptive to innovation in crypto and digital, being more receptive to consolidation of regional and community banks, and being more receptive that we don't need as much capital in the larger banks so they can do more business. Pay attention to those policies and pay attention to the Fed.
That's really important and good advice. Help me understand, Larry and Bob, the consequence of those things. Our friend Jeff Beatty, who's an extraordinary investor, has drummed into my head that you can be as right can be on which things to invest in, But if you're not right on which currency you're in, it doesn't matter. And you just painted a really important picture there, Bob. If the dollar's declining, Larry, Bob, what do we do as individual investors, as professional investors, to make sure we're in the right currency?
Well, from my point of view, if you're a dollar-based investor, you're gonna have your performance measured in dollars. The tougher question is for someone like Atlas Merchant Capital, where for our investors, we're investing in the US, Euro, and Sterling. And so we want to always have a bit of a macro view, but you don't want to overdo the currency impact. The single most important thing to Jeff Beattie is to get the right industry and the right company. And if you see a significant move, like 6 months ago, I think it would have been appropriate for us to hedge the dollar exposure. I think part of that move is done now, but you don't want to get into the micro business of hedging currencies and being a day trader in currencies. That ought to be your profession if you do that. But I think when there's a major trend, you want to put a hedge on.
Gotcha. Larry, people listening, I'll ask my question. What should I be looking to advise the people in the businesses we're involved in to do this for the next couple of quarters? You say, and I'll put the other question out there, which is the people who are making these policy decisions at the Fed level that you look at so closely, Larry, Bob, at the government level that you just articulated so well. They all want to maintain control of the Congress. Midterms are coming up next fall, so 15 months from now. It takes a while for the public to feel different, to change their attitude. You say it's going to be a softer second half of the year, Larry. So as we move to the next year, what plans do they have to change the public opinion about the impact of these policies so that come this time next year, public are feeling pretty good so they keep them in power in the midterm elections?
This is it's a great question, Jim. Again, I try to stay away from politics, but we do have the midterms coming up. It's going to be a big deal. And to me, this is one reason for the resilience of the U.S. stock market is, if these, we went from average tariff rate of about 2.5%. We're at about 15 now. This is huge and would be very destructive. We've seen already backing off. As I mentioned, after the stock market decline, we put a pause on. We've just extended the pause. I think the market's probably right in thinking they're going to end up backing off, bring up a few concessions that other countries made, say we won this battle, and take them off. And I think we've already heard the president talk about, for farming, immigration's okay. I would not be surprised over time because I'm telling you, there's no getting around demographics. Why is the domestic labor force declining? Because of an aging population, with a very low birth rate, which has nothing to do with policy. Women are getting, they work more. They
not in the Diamond family, Larry.
Yeah. So the baby boomers are retiring, and the lifespan's increasing. So the population's aging. There's little you can do about that. The immigrants have been filling the gap. That's what's happened. You look at 88% of the growth in the labor force from 2020 through 2024 was immigrants. Now we've got a dribble coming in. Now I think you can open the door to more legal immigration. I think a lot of that stuff. I think what'll happen is not only the farming industry, which already he said immigrants are okay there. He'll open it up to construction, which is another area.
And Bob wants to charge $5 million for a green card.
Right. So but I think that's what's got to change. Otherwise you're going to see very weak economic growth and higher prices. If they don't back off the tariffs and immigration, that's what's going to happen. And I think, Jim, you make a great point with the midterm elections in November of next year. They're going to have to pull back on some of this stuff. Otherwise, it'll get ugly. The market's assuming because of that, that's what they're going to do. And I think that's not crazy to think that way.
Bob, bring us home. You mentioned community banks. You think the deregulation that's likely to continue there. You see more capital flooding into those markets, which you think is a good thing because you've pointed out to us for the last year or two how important the regional and community banks are to the economic activity of this country because they're the primary lenders to small and medium businesses. So, what does that portend for your investment thesis and for our economy in the 6 months ahead?
We're looking very, very attentively at regional and community banks. We have a fund focused just on regional and community banks. We're looking to do 3 or 4 significant investments into a regional bank who has plans to acquire 1 or more community banks. The smaller, more private community banks that have been around for decades and serve such an important purpose. In this day of technology and AI and instantaneous deposit movement, they're just too small to succeed given the cost of regulatory compliance and technology. 4,500 of these banks is probably the wrong number. We think it's probably something closer to 1,000, and that we'll see consolidation over the next couple of years that brings us there. Here's the important thing. It's going to make the regional banks stronger, better for the small businesses and family-owned businesses, better competitors to the large banks, and it'll make our financial services industry in the U.S. even stronger. And it's already one of our biggest competitive advantages. It's why our economy has recovered from COVID so strongly relative to the economy in Europe, as an example. So we are really, really encouraged. And I think it's great that Secretary of the Treasury Bessent has spoken out strongly in favor of this. They're encouraging this private capital coming in, the consolidation to make stronger institutions, the importance of this sector in terms of lending to small businesses and family-owned businesses. So we're pretty pumped. Also looking at Circle and following my principle of follow the Fed and follow the policies of this administration. They're very positive in being less obstructive, more supportive of crypto, stable coins, blockchain, and we're very focused on that area, Jimmy, as well, to follow up on the very successful investments we've made. And by the way, holding on to in Circle.
Well, in the last 12 minutes, the market cap has gone up by over $1 billion. So apparently you're having an impact, Bob. So my layman's interpretation of what you two smart men have laid out for me now is that, yes, the market's at a peak today from and up for the year. We'd expect that it's going to be an interesting and softer next 2 quarters. You'd expect a Fed rate cut or 2 this year. The second half is going to be not as robust as a result of uncertainty around tariffs, immigration freeze until we get legal immigration to where it needs to be to feed the economic needs of labor in this market. The dollar will likely continue to decline. Capital inflows will increase, which will restore the small and medium business lending in the regional and community bank community. The impact of that sounds like we'll have a softer second half, but you both seem, if I follow the arrows here, that you're expecting early next year to be very strong and that everything's guided toward making that very strong. And for those who think there's a political motivation here, they'll want those who have the power at the Fed and at the regulatory level and at the administrative level, they'll want us to be feeling awfully good about how things are a year from today.
Good wrap up, my man.
Well, thanks, guys. I look forward to dunking my head in your knowledge every quarter, and this one has been a doozy. And all of this, and we're not mentioning that 2 wars have gone on in the last quarter. One continued, one started and stopped, we hope, and yet the market's at an all-time high. Lordy days, who knew? Thanks, guys. Thanks for another great Atlas Quarterly Macroeconomic Update.
Thanks, Jim.